So cost of capital, okay, going straight to the material, it's simply the return that the different providers of capital require, okay, for them to part way with their money. In short, for them to finance you, every financier will be expecting a return on their money. Okay, therefore, the return that the different capital providers expect to receive for their investment in the company is what referred to as the cost of capital. It's what referred to as the cost of capital. Okay, the return that the different providers of capital expect. Okay, and at the end of the day, you may want to make an evaluation based on the different provider of capital. Okay, on average basis. Okay, what return do each one of them expect? Okay, so you can what call we shall be discussing this. What called determining or called weighted average cost of capital. Okay, so simply trying to weigh, okay, depending on who financed you, okay, out of, for example, out of $100 that you have for capital, how much came from equity shareholder? 30% came from equity shareholder, 20% came from debt holder. Therefore, between the two of them, the equity shareholder and the debt holder, on average basis, okay, what should be the cost of the company? Okay, if you obtain 0.3 from debt holder at a cost of 10%, okay, and you obtain 0.7 or 7% of your capital from the holder at a cost of 8%. So on average, you should combine these two. Okay, what therefore would be the cost to the company? That's the last thing shall be discussing from this topic. Okay, and this is a really core topic. So definitely you expect that the examiner will ask questions from this area. Anyway, let's go straight to material. So cost of capital, as I mentioned, one of the key ways you can try to view it is simply the cost of funds. Okay, that what return if I was to go and ask this bank A to provide me with a loan, what is the cost to me as the borrower? What interest would I be paying to them? So simply the first we are trying to look at cost of capital is simply the cost of funds. Okay, the required rate of return by the different providers of capital. Okay. The other way you can try to get cost of capital is what called the minimum return that the project must yield. Okay, if you remember when we were discussing on IRR, okay, we said that at the IRR, the only way that we can accept an investment as a company is if it is going to be yielding a return higher than cost of capital. If you still remember, okay, that's based on IRR, that the project will only be financially acceptable if the cost of capital is lower than the IRR, or simply the IRR is greater than cost of capital. So the main return that the project must yield, the project must yield is referred to the cost of capital. Okay. Then the last thing is what we call the opportunity cost of finance. Yeah. The only way that the provider of capital are going to give you money or funds is if you did, if as a company you did give a return at least equal to what the provider of capital could have obtained if they were to invest elsewhere. Okay, if it's a shareholder. Okay, let me simply do a simple illustration. If you're a shareholder, okay, this is equity shareholder. Okay, this is equity shareholder. If you were to invest in project A, okay, and you are the project B, if you were to invest in project A and earn a return of, let's say, 12%, there's no way they can finance you as project B if you don't give at least 12%. Okay, the only way they can finance you is in case you give at least return equal to 12%. Okay, for example, 13%. Okay. Therefore, the cost of capital, okay, for the company, therefore, can also be viewed as a mean return, the minimum return of the return the shareholder could have obtained if you were to invest in the next best alternative, or called the cost of finance. Okay, so those are three ways you can try to define, okay, or to view, okay, what we mean by the cost of capital. Okay, and you see that the other day that the different provider of capital, there will be the return they'll be requiring is based on the amount of risk you'll be exposing them to. Okay, if you remember when we were discussing on the appraisal and the risk, how we incorporate risk, okay, in appraisal projects, we say that if you're going to be invested in a high risk project, then the provider of capital will be expecting high returns. Okay. The same applies here, definitely. Okay, that if this investors, they're going to be investing in you as a company where the risk exposure is quite high, then of course they'll be expecting more premium. Okay, so the bare minimum, if the investors want to invest in a risk-free asset, if they to invest in an asset there is no risk, okay, that asset, the T-bills, the T-bonds, they'll be yielding returns, what referred to as the risk-free rate of return. Okay. However, since you are a commercial company, you're not the government, Therefore, you have more risk, okay, more over and above what the government has. Therefore, they'll be extracting premiums, okay, premium for the risk exposure towards the business risk and the financial risk. What's the business risk? The chance that as a company, you may not be able to achieve the profits, okay, make money, okay, from your business, okay, simply because of the nature of the business you are involved in, okay. Financial risk, simply the chance that you cannot be able to pay for your obligations as and when they fall you because of the way you do finance your assets. Okay, if you use more debt, then you have higher financial risk because therefore most of your money is going outside or out of the company through interest payment. Okay. Therefore, the return the different provider capital expect, therefore, is a component of risk-free plus, of course, the risk premium based on the business risk and the financial risk exposure. Now, one of the key component, one of the key source of finance of the company, of any company definitely, is equity. Okay, equity is one of the key component of finance costs. Okay, of capital source. Okay, and how therefore do we determine the cost of equity? Simply, the return that equity shareholder expect to receive from their money. We are going to use two models. Okay, that are used to estimate what should the cost would be the return to the different provider capital. The first model called the dividend valuation model, which is based on the fundamental theory of valuation, which I think we mentioned together when we were doing valuation of bonds. Okay, and here we call the capital asset pricing model, Acca Fm. Okay, the two models you can use when it comes to determining the cost of equity. Okay, so as mentioned, the dividend valuation model is based on the fundamental theory of valuation. And let me remind the fundamental theory of valuation. Okay, I know you do remember, but just remind. Okay. Give me a minute. Here it is. What happened? Okay. Okay. This is a reminder of the fundamental theory of valuation. And you see that as per the fundamental theory of valuation, we say the market value of a financial instrument, okay, financial security, financial instrument, okay, or a security is simply the sum. Security is the sum of present value, is the sum of present value of all the cash flows, some present value of all the cash flows to be received of the cash flows, sum of present cash flows, simple all receipts, okay, to be received over the life of that security, received over the life of the security. Okay, that's what simply called fundamental theory of valuation, which I think you mentioned when we were discussing on how to value bonds. Okay, so in case you apply the same concept, okay, then when it comes to equity, then refer to it as the dividend valuation model. So in case you are an equity shareholder, what return do you get? Brian, in case you're equity shareholder, what return do you get? What cash flow do you get?
The dividend.
Dividend, of course, you get the dividend. Okay, therefore the market value. Okay, of course, therefore you get the dividend. Okay, the return you get therefore is the dividend. Okay, which means therefore we say that the market value P naught of the equity share therefore will be equal to simply the sum of present value of the dividend. So since there is no add life to an equity share, there's no add life to an equity share, then therefore simply the amount of dividend, the present value of all the dividends will be seen over the life of a particular equity share, therefore give the current market value of the equity share. We assume the market is perfect, okay? Which means therefore the market value of this particular equity share, therefore, since this go to infinity, therefore this will be equal to sum of present value, okay, from today, that is year one, okay, from year zero, from today, simply let's say from year one, okay, because today's has already been paid, all the way to infinity, the sum present value of the dividend, therefore give therefore the market value of that particular equity stock, okay. So in case we are to make let's first make assumption that there's no growth in the dividend, okay, that simply the company pays a fixed dividend, okay. The other assumption we make that all companies pay dividend. Then another assumption we make as per this model, all companies pay dividend. Which means therefore, if you are to assume there is no growth in the dividend, then therefore dividend paid today, D not today, is equal to dividend to be paid in 1 year from now, is equal to dividend paid in 2 years from now, is equal to dividend paid in the end year. So there's no difference, okay. Dividend paid today, year 1, year 2, year 3, all there's no difference, okay, simply because they're not growing and the company is paying dividend, okay, at a constant rate, okay. In that case, therefore, recall what you said that about how we get the present value of this is an annuity, actually this is an annuity, but it's not changing, okay. Recall how we get the present value of an annuity to infinity, okay. It's again simply the annuity we divide by R, okay. That will get the present value of an annuity to infinity. So in our case here, the annuity is a dividend which is fixed, okay. The annuity is similar to the dividend, therefore the market value, the present value, okay, this is the market value, the present value, okay, this is the present value, some present value, therefore P naught, the market value of this equity share, therefore be equal to the annuity is the dividend, we divide by R, where R here is the cost of equity, okay. Therefore, to get the cost of equity, we make simply the cost of equity, let's start with the formula. With the dividend, we divide by P naught, and we express this as a percent, okay. And that's simply so we get the cost of dividend, the cost of debt, so the cost of equity, okay. If the dividend is growing, is not growing, okay, simply the dividend paid is a fixed, okay, is a fixed, is being paid, is a fixed dividend, okay, all the way to infinity, okay, where so that RE is the cost of equity, okay, D is the annual dividend, the annual fixed dividend, and of course P naught is equal to the current market value x dividend share price. Simply, so get the cost of equity using the dividend valuation model, which is pegged on the fundamental theory of valuation. Clear? Sakina?
Yes.
Great. Let's just apply the formula then. Okay, as I mentioned, some of the assumptions that we're making is that the company pay dividend, okay? Company do pay dividend, okay? The assumption, because can have cases where company don't pay dividend. And by this, as I mentioned, sometimes examiner can ask you, what are the assumptions of the model, okay? Or sometimes, what are the limitations of the model, okay? And as I think I've been telling you, don't forget, the limitation of a model are the assumption. If the assumption can't apply in reality, and all the assumption here, which can't apply in reality, is simply the company pay dividend. There's some company that don't pay dividend, okay? So does it mean that they don't have market value? No. So therefore, that's one of the key limitations of the model. Okay, any question? No question, great, okay. Then go through this question, we did attempt to do it together. Question 1. Okay, assume that you've gone through the question. So it means as you get the cost of equity, okay, for this particular equity stock, okay, simply cost of equity is the dividend divided by P naught, and we express this as a percent. The dividend is equal to 30 cents, okay, it will be equal to 0.3. We do a P naught, don't forget P naught is X dividend, okay, therefore which is 1.5, and we express this as a percent, and we get
20%.
Do number 2. first make the attempt number 2. So that's therefore how you get the cost of equity of the company. So what if there's growth in dividend? Going back. What if you have growth in dividend? That the markets, that the dividend is not constant. However, it is growing at a constant rate to infinity. Okay, if that's the case, therefore, we need to factor in the growth. If there's growth in dividend, then we call that the sum of present value of an annuity that is growing at a fixed rate to infinity is given us the present value. The sum of all those dividend annuity to infinity is given us the annuity. We factor in the growth 1 plus g, okay, RE minus G, okay, where R is discount rate, okay, G is the growth in that annuity. Now, if you apply the same concept here in the case of an equity share, okay, P naught, you see that here the annuity being the dividend, it is growing at a constant rate. Okay, so from the D1, okay, which is therefore D naught, which is what we just paid. Okay, what you're getting paid next year is growing at a fixed rate. Okay, now therefore it will be equal to 1 plus G. Here, don't forget R is a cost of equity. Therefore, cost of equity minus G, where G is annual growth in the dividend. Okay, we'll get simply flowing from this particular equation. Okay. Which means therefore P naught, where G now, P naught remains as X dividend, D naught, just P naught is X dividend, where D naught is the most recently paid dividend, R is cost of equity, G is annual growth in dividend, annual dividend growth rate in dividend. What we want to determine is to get the cost of equity, where this is which is the discount rate here, okay, more or less here, okay. Therefore, to make it a simple equation, therefore RA will be equal to D naught 1 plus G divided by P naught plus G. Simple as that. That's if we get therefore the cost of equity, you have to use the dividend valuation model. Okay, I've just made here the cost of equity here, the subject of the formula. Here, question. Okay, that's it. Okay, let's apply in a question then, if that's clear. Okay, so this question. What do you get?
I got 15.
15%. Okay, so first is to determine that this is cum dividend. That's the first step. That means therefore you need to remove the dividend in short to get the X dividend. Therefore, the X dividend, okay, P naught, therefore be equal to the cum dividend 1.05 minus the dividend, which is 10 cents, okay, 0.1, and to give us therefore how much? To give us 0.95. Cost of equity, don't forget, is D naught, okay, 1 plus G if there's growth in the dividend, P naught plus G. D naught, it's 10 cents, 0.1. The growth is how much? 5%, 1.05. Okay, P naught is equal to 95, 0.95 plus G of 0.05. And get how much? 50%?
16.05.
16.05%, therefore the cost of the dividend. Simple as that. Question. Be careful, by the way. Be very always careful with what is the share price given there. Okay, is it cum dividend or is it ex dividend? Because if it is cum dividend, then you have to remove the dividend to get the ex dividend. Clear? Question. The next question is that how do we determine the growth in the dividend? How do we determine the growth in the dividend? Okay, we can determine the growth in dividend, okay, using two ways. Okay, one is to use the historical growth in the dividend. In short, you determine in the previous 3 or 4 years what has been the growth in the dividend, what has been the annual growth in dividend. If it was 10%, then you assume that going forward the same shall be repeated. Okay, that's an assumption that you make. Okay, simply we call the use of the past historical growth rate in dividend to be the future growth in dividend. Or you can use or refer to as the Gordon's retention model. Okay, or they'll simply call the Gordon's model. Okay, it's called the Gordon's model. Where with the Gordons, okay, there's a name of person Gordon. Okay, I see that the growth in dividend to the company is influenced by two factors. One is how much you retain today, because in case today you retain a lot of your earnings, then in future you'll be having more finance upon which you can invest. Okay, and those investments we assume they yield high returns, of course. Therefore, the first factor that influences the growth in dividend is the retention. How much do you retain? Because if you pay all your earnings as dividend, then in future you would have finance to invest in projects. Okay. Then the next factor that influences the growth in dividend is the return on equity. How much return are you making? Okay. Because once yes, you have the money, you have the finance, retained earnings as one of your key financials. However, what about the project themselves? How much return are they giving? If you therefore then investing in high yielding projects, okay, therefore you'll be having more earnings upon which you can pay more dividend in the future. Okay, those are the two factors that influence the growth in dividend. First is retention ratio. Next is the return on equity. Upon invest that equity capital, how much return do you make? And let's first begin by the first one, called the use of the historical growth in dividend. Okay, an example. In the first example, what do you get? Daisy, what do you have?
Not done that.
Nafis, how do you get?
I got 60.
60%.
Yeah.
That is very high. Anyway, let's attempt to do it together. And so we told that the growth in areas has been from 20 cents all the way to that 2 cents, but don't forget this is over 5 years. So we want to get per year, therefore, because of the growth in dividend. Let's say this is year 5. Let me call this D5 for the sake of argument. So D5 is equal to D naught, which is like today. How many years of growth? We have 5 years of growth. Okay, 1 plus growth, the growth in dividend to the power of 5. The same way we did the case of inflation. Hope I still remember. Okay, the same thing with case of inflation. We want to get now the G. Okay, and therefore the G will be equal to D5 D naught, 5 years of growth. So to the power of the fifth root minus 1. Therefore, this is that 2 cents out of that 20 cents. Okay, fifth root minus 1. And you get
9.9.
9.9. You get 9.9%. Simple as that. What about this number 2? Okay, there's a attempt. Don't forget the growth has been, it grew from 10%, sorry, 10 cents 10 cents all the way to 14.5 cents over how many years? Over 4 years. Okay, over 4 years. 2010 all the way to 2014 over 4 years. The imply therefore the growth in D therefore will be equal to D 2014. Okay, D 2010, for example, 4 years of growth, the power of a quarter minus 1. Now this will be equal to D 2010, this is 14.5 over 10 to the power of a quarter minus 1. I get 9.7.
Yeah.
9.7, okay. I get therefore 9.7% to be the annual growth in dividend. Okay, don't forget, simply here you take the extremes. Take the beginning of the period and there the period. Okay. So this is what we call the use of geometric mean, not the use of arithmetic mean. Okay, we still use the geometric mean. Any question? Okay, great that you are able to understand. Then the next model you said regarding how to estimate the cost, the growth in dividend is called the Gordon's retention model. Okay, where you say that the future growth in dividend is influenced by two factors. One is the retention ratio, and you have return on equity. Okay, this is return on equity. This is a little return on equity. In short, okay, it makes a lot of sense that if today you don't pay a lot of dividend, then what does it mean? It means in future you'll be having a lot of finance from your past earnings. Would imply therefore you'll be able to invest in those projects in future. Okay, which imply therefore since you have a lot of finance, then you have the chance of invest that money and earning returns. Okay, the other factor is return on equity. Once now you have invested those equity finance, equity capital, how much return do those projects gives you? Okay, if you're going to invest in valuable projects, okay, that yield high profits, high earnings, that imply therefore you pay more dividends. Okay, therefore those are the two key factors that therefore do influence the growth in the dividend. Okay, the retention ratio and the return on equity. Okay, therefore the growth in the dividend is influenced by those two factors. Okay, now this is the formula that you examine. I will give you, but they won't explain what B is, what is G is, what is R. Okay, but it's one of the formula that your examiner will give. Give an example here. Go through it, we discuss together. What do you get? Sanya?
So I don't know if this is too high, but I got 54.
That is extremely high, I guess.
Yeah, I think I messed up somewhere. I'm just going to do it again.
Okay. Brian?
I got 2 points.
2 points. That's too low.
Yeah.
Nafisa?
I got the same 2.5.
Okay. Sakina? Sakina?
So I'm still doing it.
Okay. So let's just do it together. So the company is about to pay, okay, 16 cents per share, and the share price of the company is 200 cents. Okay. So actually okay, let's just continue the way it is. Okay. So since the company is about to pay, here I think there's something that I missed myself here. Since the company is about to pay, don't forget it is not yet paid. Therefore, so here let me change the share price. This is silent, okay, but it makes more sense if it is come dividend. So this share price is come dividend. Okay, let's simply make that simple adjustment. This is come dividend share price. Okay, come dividend share price. It will make a lot of sense if it is come dividend, not ex dividend. Okay, because the company is about to pay. Okay, so having that in mind, the company is about to pay. Therefore, that means the share price is that in case you do buy the share at that point in time, then you can buy the share plus the right receipt of the dividend. Okay. So since the company is about to pay, then therefore that even though D not we said is equal to the most recently paid dividend, By the mere fact the company share price is come dividend, that means therefore we can assume that to become our D naught. Is that clear? Don't forget, D naught is the most recently paid dividend, okay, past tense, okay. However, since the share price is come dividend, then we can assume, okay, that simply that is our D naught, okay, which is equal to therefore 16 cents. But the P naught, which is the XD share price, therefore we remove the dividend, okay. So don't forget I've said that we adjust that this share price is come dividend, because if it is silent, then we assume this X dividend. But for this, it makes more sense if we assume that it is come dividend, because the company is about to pay. Okay, if they are paying in 3 months, 4 months time, then the share price will not become dividend. But here, because it's about to pay, okay, assume that is in the near future, in the next few days or weeks, maybe. Therefore, to be equal, therefore, $2 minus 16 cents to give therefore 1.84. Okay. If you did use $2, it's okay. Okay, but the examiner here, I should have done that adjustment. So 1.84. How we done that? We have D naught, we have P naught. What else? We get a G. The growth in dividends is B times R, where B is the retention ratio. You pay 20, it means you retain 80, 0.8. The return on equity is 12.5%. Therefore, 10% will therefore the growth in the dividend. Therefore, cost of equity is equal to D naught, which is 0.16. Growth is 10%, 1.1. P naught, 1.84. Growth is 10%. To give us how much? There's no harm in case you did use $2 as your P naught. It's okay. There's no harm. Okay, well, as I mentioned, as by your exam is going to be explicit. Okay. Anyway, so what do you get?
$19.6.
19.6%, therefore the cost of equity. Okay. Clear? Question? Okay, no question. Great. Then, as mentioned, okay, I'll leave you to go through this, how to get the assumption, the model assumptions, and the limitation. So I'll leave that to you. Okay. The next model you can use when it comes to estimation of the cost of equity is called the capital asset pricing model. The capital asset pricing model. And there's the model say that one of the key drawback of the dividend evaluation model was that it is assuming that the cost of equity, okay, or the return the equity shareholder expect to receive is influenced by the future growth in the dividend, the potential future growth in the dividend, the current dividend. Okay, in reality, the cost or what you require as an investor is more linked with the risks that you're going to be exposing yourself to. Okay, so the element of risk need to appear. Okay, that at the end of the day, in case you're going to be investing in a risky project, then what do? You'll be requiring higher returns. Okay, if you're going to be investing in an investment where there's no risk, then of course, definitely it gives you lower return. Okay, simply that's the reality in the market, that the more risk exposure, okay, not more risk, the higher the return that you're going to be receiving, that will have to come with risk. There's no way they're going to be, for example, making high returns, okay, if you're going to be having a zero risk asset. So it is not possible. It doesn't happen in the market, okay. So that's therefore the element of risk has to come in play then for sure, okay. And this model says that at the end of the day, what matters simply is therefore the risk, okay. We need therefore to ascertain what is therefore the required rate of return on equity capital based on the amount of risk that a company will be exposing the equity shareholder to. Okay. So here we see that there are two types of risks that we need to consider. Okay, we have two types of risk of the two risk of security. We have one called the systematic risk, and we have called the unsystematic risk. Okay, we have the risk of systematic risk. Okay, referred to as market risk sometimes, and we have called the unsystematic risk. So the two risks that the investor will be exposed to. Okay. Therefore, we need to determine among these two risks, therefore, okay, which one, therefore, will there be compensation? Because not all of them have compensation, okay? For instance, the case of the systematic risk, okay, what we call the market risk, okay? So since this is market risk, it's market-wide risk, okay? But even therefore, you as individual investor, you may not have the power to control it, in quote, okay? You don't have the power to control it because it's market risk. It implies therefore the company need to compensate you, okay, for the exposure towards that type of risk, okay. Then you have called the unsystematic risk, okay, which you refer to simply as the firm given risk, okay, the firm given risk, okay, which I think for those who don't audit, okay, you have to cover this already, and going concern risks, okay. So those are the more risks. Those are the more risks. For example, the death of a founder, okay, in itself is a what we call is a firm given risk, okay. So it does it affect all the entire market? No, okay. It's only going to be affecting that individual firm, okay. And that's why sometimes we refer to them as the firm given risk or the firm specific risk, okay. That because they only be affecting that particular company, okay. So that's on the two risks, okay. So let me so the two risks that we need to consider, okay. What's called the systematic risk, and you have called the or the non-systematic risk. And this is called the market risk, and this is firm specific risk. Okay, so you see that here, don't forget, you as an individual investor, okay, this is the risk that will be compensated for, okay. It's called actually price risk. It has a price because it's compensation. However, if you expose your equity stock, okay, to this firm given risk, then the market does not reward you for that. Why? Because the risk was not affecting the entire market, okay. The risk was only affecting you as a given the investor of that particular firm only, okay. If you have board managers who are corrupt, okay, it's not going to be the same for all the firms within the market, okay. It's only you, those board members, for example, they are corrupt, okay. So this is called the firm specific risk. The market therefore will not give any compensation if you are to expose yourself to this two type of risk, okay. So as I mentioned, the systematic risk, okay, this is what we'll call, it is going to be affecting the entire market, okay, so it does not matter, okay, where you invest, whether you invest in tourism, you invest towards telecommunication industry, you invest towards manufacturing setups, okay. So, for example, okay, the current pandemic crisis you have, okay, it's not going to be affecting only one industry. Every industry is affected, okay. I think I've seen all over, okay. Like Safaricom, okay, I think they have dropped, okay, in terms of the growth in their profits, okay. The same KCB, okay, Agribank. So every individual company is to be affected one way or another, okay. But of course, there's some affected more than others. For example, tourism, okay. The effect of the crisis has been more towards the tourism, okay. So the exposure towards the risk might be different. However, every individual investor will be affected in the particular economy, okay. So the risk is market wide, okay. It is not unique, okay, to that particular farm only, okay. It's for the entire market, okay. So therefore, there ought to be premium that, hey, if you are to invest as an equity share, you'll be asking, if I invest in this particular industry, okay, if I invest in this particular company, okay, will I be compensated for that will I be compensated for that particular market risk? If not, then don't invest, okay. If you're not willing to assume the risk, okay, don't invest therefore, okay. Therefore, the key element is that every individual investor in the market is being affected, okay, in one way or another, okay. So therefore, the market therefore ought to be giving you premiums because you can't control it, okay. Even if you invest in another country, okay, the crisis is still there, okay. It doesn't matter. For example, in this currency we are in, okay, it doesn't matter at the end of the day, okay. Every individual investor will be affected by this risk, okay. So since you can't control it as an individual investor, then what do? We have therefore to consider the market. Therefore, we have to give you premiums. Okay, and that's why therefore I will refer to it as a priced risk. This is a price. This is a premium. If you expose yourself therefore to that, if you invest in a particular economy, okay, because you can do nothing, you'll be exposed to it either way. That's the case of the systematic risk. Okay. Then you've got the unsystematic risk, okay, as mentioned, okay, so now if we advance the non-systematic risk, okay, they are firm-given risk, okay, they are firm-given risk. Why? Because they are only domiciled in that particular company, okay. If you don't have, if the company doesn't have maybe a good going concern, okay, it's a family business, okay, there's no good going concern, okay, the son, the daughters, maybe they don't want to run the company of the company, okay, of the family, okay. That's the risk. The individual to a farm, okay, it doesn't spill over the entire market. Okay, if you have issues regarding what the best, okay, maybe you have issues regarding KRA, okay, maybe I don't know because you've been having some bad business deal, okay, KRA has issues with you, okay, they have frozen your account. It doesn't mean that the KRA is going to freeze all the accounts of the company. No, it's you. It's a particular farm that has a particular exposure towards a particular type of risk. Okay, if you have too many substitute products, okay, that you whatever you're offering, okay, the substitutes are too many. Okay, so what does that mean? It means therefore your exposure towards that risk is not for the entire market. It's you as an individual firm. Now, in case you feel that maybe you as an individual investor, you don't want to experience this risk, what do? You can dispose of that share, buy another one, for example. Okay. Which means that for you as an individual investor, you can be able to reduce your exposure towards this risk, okay, by, for example, disposing of stock A for stock B, okay. If you have lost money in company in, let's say, EABL, okay, you can decide, I'll invest in Safaricom, where maybe they have better managers, I don't know, just trying to say. Therefore, it is possible for you as an individual investor, you take your own unique step, okay, without incurring high costs, okay. You can be able to, therefore, to what we call rebalance your investment, your portfolio, okay. You rebalance, therefore, your group of assets by simply disposing some and adding others, okay. Actually, in theory, okay, it was that if you're going to have at least 16 shares, okay, from 16 to 30 securities in your group of investment, what we call a portfolio, okay, then you'll be able to do away with the firm-specific risk. Okay, you'll be able to do away with the unsystematic risk. Okay, if you're going to have at least 16 to 30 assets that form your investment. Okay, therefore, it is possible for you to be able to do away with this risk. Therefore, since it is possible you as an individual investor to do away with this risk, then there's no premium. Okay, and that's I think I've mentioned. They're also called the unpriced risk. There's no premium. Okay, there's no price for them. Okay, we call the unpriced risk. Okay, death of founder, for example, substitute products, loss of a customer, okay, supplier, for example, actually, okay. So again, all those factors that you did mention, all those who have done audits, okay, the going concern issues, all of those are firm-specific risk. And it's just on the two risk, okay. So since there's no compensation, okay, for the unsystematic risk, therefore, what do we do? Okay, we are not going to pay more, a lot of concentration towards it. What matters in our analysis is the price risk, the systematic risk. The question therefore remains, therefore, how do we measure, okay, what we call the systematic risk, okay? So how therefore do we measure the systematic risk? We measure the security systematic risk exposure through the use of called the beta coefficient. The beta coefficient. And don't forget, as I mentioned, we're trying to observe what is the extent of the exposure of this security towards the market. Okay, we also because the benchmark, don't forget, is always the market. Okay, for example, okay, the crisis we're currently in, the pandemic, as I mentioned, there's some firms that have more exposure than others. Okay, Serena, for example, okay, they have more exposure than Safaricom. Why? Because they're in tourism. Safaricom is telecommunication. So, of course, therefore, every person is affected, but to a different degree. Okay, therefore, how do we measure that difference in the degree of exposure? We use the beta coefficient. How do we do it? We compare. Okay, the beta, okay, is giving us the covariance of that stock. Okay, now see this is Serena, just example. Covariance of Serena stock return. Okay, we compare to the market. The market is the entire portfolio. Okay, like example Kenya, then a C20 index. Okay, versus what the individual risk for that particular stock, the variance of Serena stock, for example. Okay, Don't worry about these formulas. You're not going to be tested, but just to understand. Okay. So if we are comparing the risk exposure of the risk exposure of Selena towards the market, we divide by the risk of the variance of Selena itself. Okay, just an example. Or Safaricom, whatever stock you're trying to analyze. Okay, so compare the covariance, and versus the variance, covariance of Safaricom towards the market. Market means the entire market. In Kenya, you can use therefore the NFC 20 share index as to represent the market in short. Okay, then you divide therefore by the variance of the return of the particular stock you're trying to analyze. Okay. Simple as that. Now the next thing, I don't know whether you guys have done covariance, I don't know, but at least maybe along the way you should have done. But this variance, standard deviation, those one at least you have done. Anyway, the covariance, if for example you're trying to analyze what's the beta coefficient of the market, you want to know what's the beta coefficient of the market, it will be equal to covariance of the market towards the market, because you're trying to analyze the market. Okay, covariance of the market towards the market. How does the return of the market vary with the return of the market? We divide by the variance of the market because you're trying to analyze the market. And I have a simple question. I don't know whether you're going to get this, but in case you do, this is going to be very encouraging. What's the covariance of an asset towards itself? The covariance of the market towards the market. What's the covariance of market? Let me give the formula, covariance. The covariance of market towards the market can be given as, the sum of, definitely you can add the sum of deviation, return, we call this R is the return of the market minus the mean return, this is deviation, mean return. We multiply by the return of the market because the market was the market. Let me first begin with Safaricom was the market. Okay, so let me begin. Safaricom was the market. The covariance is simply the return of Safaricom minus the mean return of Safaricom. Okay, this is the market towards the market, return of the market minus the deviation of the return, the mean return of the return of the market. Okay, n minus 1. Now, if we are to do the covariance of the market, the second set here, covariance of the market towards the market, will be equal to sum of deviation, return of the market minus the mean return of the market times return of the market minus the mean return of the market divided by n minus 1. So what do you get? What do you get here? Covariance of the market towards the market. You know how to get the variance, how to get the standard deviation, then this is not something hard for you. Brian, what's the covariance of an asset towards itself?
Variance.
Variance, great, that's good. Okay, here simply we can summarize this equation and say this equals to return of the market, deviation of the market towards the market squared divided by n minus 1, and this is the variance. It's simply the variance of the security. And so here, so since now we know this is the variance, therefore the beta coefficient of the market is equal to the variance of the market divided by the variance of the market to give therefore 1. Okay, so don't worry about the formulas, okay, for now, okay, but it's good at least one of you have got it. What I was trying to bring forth is that the beta coefficient of the market is always equal to 1. The beta coefficient of the market portfolio is always equal to 1, which means therefore in case we have a stock, okay, that has a beta of 1.2, then that means therefore compared to the market, this stock is more risky. Okay, don't forget, as I mentioned here, a similar covariance of the stock towards the market divided by the variance of that particular stock. So we are comparing with the market. The market has a beta of 1. So in case the stock here, let's say the stock of Safaricom has a beta of 1.2, what does it mean? It means that shares of Safaricom are more risky, okay, than the market portfolio, than the NSE 20 share index. So since there's more exposure towards the risk, then you expect therefore more return. Okay, therefore the higher risk, therefore more expected or required of return. If the beta is 0.8, so you compare that to the market. The benchmark is the market, okay? Which means therefore this stock is less risky compared to the market. Okay, the stock is therefore less risky than compared to the market portfolio. Clear? So the key takeaway, the beta coefficient of the market is equal to 1. That's the key takeaway here. Beta of 1.2 means that the stock is more risky. It has more exposure towards the market risk compared to the market. If it is 0.8, it means for the stock has a lower exposure towards the market risk compared to the market portfolio. That's the key takeaway here. That's what I wanted to bring forth. So the formulas, for now, don't worry too much about them. But the measure of systematic risk is the use of beta coefficient, okay, which I think maybe as we advance along the way, you discuss them in detail later on. Clear?
Question.
Yes, Brian.
Is it going to be tested?
No, this formula is not tested. So this formula here, they will not be tested. All these will not be tested. However, this can be tested, okay? How to, what's the beta of the market, or how to interpret the beta, okay? So this can be tested. What's the beta of the market, or how to interpret 1.2, how to interpret 0.8, that one can be tested. But the formulas, no. Clear? Brian, clear?
Yes.
Okay, great. That's therefore we measure the systematic risk through the use of beta coefficient. And as I mentioned, the market has a beta of 1, okay? A beta of 1.2, more risk. A beta of 0.8, lower amount of risk compared to the market. Now, what if therefore we draw a graph, okay, between risk versus return, okay? If we do a simple graph of risk versus return, or simply return, this is return versus risk, as we mentioned, therefore, and here we use the beta coefficient that was matters actually, okay? We use a beta coefficient, okay? Because as I mentioned, the unsystematic risk is there's no premium, therefore that's why therefore we don't pay attention to it. What matters is the systematic risk, okay? We're using the beta coefficient, okay? First, we mentioned at the beginning that in case you can be investing in a risk-free asset with zero exposure, what do you get, Sanya?
Sorry, so please repeat.
If you invest in an asset that has zero risk exposure, what return do you get?
You get a higher return
Are you sure?
because it's low risk, right?
Zero.
Isn't
Okay,
it?
there's no risk. Zero risk.
Yeah.
So what return do you get? What do you call it? We call it the risk-free rate of return. I mentioned about the T-bills, the treasury bonds, okay, the government issued securities, okay. There's no exposure towards risk, okay, towards the risk, which means therefore, but they give return. What do you call it? We call it a risk-free return. So therefore, even if you have an asset with zero risk exposure, they give return. What refer to as the risk-free return. So let me mark it there. The risk-free rate of return. RF represent the risk-free rate of return. The assumption the model model assume is that we have called correlation between the risk and return. Okay, they call direct correlation between risk and return. The more they exploit towards the risk, therefore, the more the return that the holders will be expecting. Okay, which is very true. Okay, that again we call a correlation between risk and return. So as the risk increases, the return expected or required increase also. Okay. Once we increase the risk here, therefore it's going to be therefore the return will also be expected to be increasing. Okay. Now here we have our graph. We have our graph here. Okay. Now what is happening here is that we have return, and as the risk increases, okay, the return of the asset are increasing. If we take a stock that has a beta of 1, what stock is that? If we have here 1, if we have a stock of beta of 1, what stock is that? Daisy?
Yes.
Yes.
Repeat the question, please.
If you have a stock that has a beta of 1, what stock is that?
I don't know.
Brian?
Sorry, if you have a stock whose beta is 1. Is it a market stock? Because it's always one.
Yes, you just mentioned it now. So that's simply the market portfolio. Okay, it's simply the average of all the stocks that makes the market. The market portfolio. Okay.
Yeah.
So therefore, in case you have there a stock equal to 1, let me just try to, in case in the it is, therefore it will be in the market portfolio. Let me call it simply, call it the M, market portfolio. And therefore, the return to be received there is here. Let me just try to put some dots here. And therefore, the return of the market, RM, market return, okay? Beta of 1, market return. So what does therefore to get therefore? What's the equation, okay, for this line equation you have here, okay? The equation for this line equation you have here, okay? Don't forget this y is equal to a plus bx. Obviously, remember this, a plus bx, okay? What is y? Y is the dependent variable, which is the return, okay? Therefore, the return. What is a? The ya is simply the y-intercept, which is the risk-free. What is b? B is a gradient. Because a gradient here, so let me simply draw the gradient. Change in y over change in x. Okay, change in y is simply the change in y, and then the change in x. Change in y is how much? Is simply rm minus rf. What's change in x? Is equal to 1 minus 0, simply 1. What is x? X is the independent variable, which is the risk, which is measured using beta. Then simply use the beta. So simply, therefore, the return of the stock, okay, is equal to risk-free plus beta coefficient of the particular stock, RM minus RF. Clear, Afisa?
Yes, sir.
And this is called the capital asset price model equation. It's called capital asset price model equation. Okay, where R is cost of equity, B is a beta, is equity beta, or beta coefficient. RM is the return on the market portfolio, market portfolio return, return, what else? RF is equal to risk-free net return. I simply refer to as that they simply tell me therefore what ought to be the cost of equity using the capital as a pricing model equation. You don't need to know the graph. Okay, it's good to know how the equation comes about, but what you need to know is the equation and how to apply the equation. Clear? Question? Okay, no question. So let's do an example. How to apply the equation. We apply now the equation. Okay, there's so many things there, assumptions which I've skipped, okay, but on your own free time, ensure that you go through them. So go through example 1. Example 1.
Sir, do we need the cost of equity as well?
Sorry, do we?
The cost of equity.
Yes, what about it? Sorry.
Is that supposed to be in the question too?
Yes, because it should be asked here, determine the required rate of return. You see,
So the rate of return that we're supposed to calculate is the market portfolio.
It's the cost of equity for this stock.
Okay, but then the market portfolio isn't given yet as well. It's just N%.
No, it's given here. The market portfolio return is 7%. What do you mean? Example 1. Have you done example 1? Or you did example 2?
No, I just thought that we have to calculate the market portfolio.
Mm-hmm.
because it's n%. So like we have to calculate that percentage.
Mhm.
But then to do that, we need the cost of capital. I mean, equity.
Okay, so are you doing example 1 or example 2?
1.
1. But
Because see, the formula states that the cost of equity is equals to the
risk-free
risk-free.
equity beta
Mm-hmm.
to the market portfolio minus the risk-free return.
Yeah.
Risk-free, the return of we're given here 6%. Clear?
Mm-hmm.
Beta
Is
1.2.
1.2.
Return of the market portfolio 11%, isn't it?
That's oh, sir. Sorry, I thought it's n%. Like on my screen, it was showing n,
It was
the
10%.
letter.
No, it's
Yeah, that's why I was confused.
okay. It is return of the market portfolio. RM, return of the market portfolio.
Okay, sorry, I got it now.
Okay, minus 6%. And what do you get?
12%.
You get 12%. Therefore, the return of the market return of this particular stock. Okay. In the next example, so don't forget, all you need to remember is the formula. Okay, I think it's one of the formula examiner provides, but you have to apply it yourself. You have to be able to know what does RE means, RF mean, okay, RM. So you have to know these things. Okay. Next, you mean to get the volatility. Okay, so what does the beta of B stock B tells us? So here you've been asked to get the beta now. Okay, so it's working backward is short. Okay, the return of this particular stock is 9%. Okay, therefore 9% is equal to risk-free, which is 5.5%. GRITs refer to, there's a common term for the T-bills and T-bonds, okay, or simply government-issued securities, which is 5.5% risk-free. The beta is what being asked to get, okay, for the stock. Return on the market portfolio 10.5, okay, the return of the market 10.5 minus risk-free 5.5. Therefore, beta therefore will be equal to 9% minus 5.5, we get 3.5%. 10.5 minus 5.5, and we get how much? 5%, and you get therefore 0.7. The beta for this stock is therefore equal to 0.7. Let's simply working backward and get 0.7. So being asked, what does that mean regarding return volatility of the particular stock? Okay, what does it mean? It means that this stock is less risky than the market portfolio. I think I mentioned that the market portfolio has a beta of 1. This is 0.7. What does it mean? It means the market portfolio is, this stock is less risky than the market portfolio. The returns, the volatility, which is simply the risk, okay? The risk, therefore, this particular stock towards the market turn is lower than the market. Okay, that's simply that's what it means. It has a lower rate of volatility if you were to compare with the market portfolio. Clear, Sakina?
Yes.
This is clear.
Yes, sir.
It's okay, fair enough. Then we meet 11:15. Now we discuss on how to get the cost of debt, okay, and the other different finance sources. Okay, see you then at 11:15.